30,000 employees opened a 6 a.m. email from Oracle leadership on Tuesday. By 6:01, their system access was gone. No manager call, no HR meeting. TD Cowen estimates this is the single largest tech layoff of 2026. Oracle's reason was not restructuring, it was not declining revenue. The company posted more than $6 billion in profit. It fired 18% of its workforce to pay for AI data centers. On the same day, 1,200 miles away in St. Louis, two Federal Reserve economists published a blog post that read like a quiet alarm. Their argument: AI optimism itself is overheating the economy. Not AI products, not AI productivity. The hype alone is acting as what they called a news shock, reshaping how households spend and how businesses invest. The St. Louis Fed paper contends that even if AI never delivers on its promises, the spending wave it has triggered is already generating inflationary pressure. Goldman Sachs, in its March 2026 AI adoption tracker, reports fewer than 19% of U.S. establishments have actually adopted AI. 80% of companies are not using it. Yet CapEx is surging as if universal deployment were months away. These two stories look unrelated. One is a corporate bloodbath, the other is an academic warning, but they share a single root. The race to build AI infrastructure is now large enough to simultaneously destroy jobs and create inflation. Oracle is not alone. Related Digital is arranging $16 billion in financing for another data center. Microsoft is in talks with Chevron for a $7 billion gas-powered energy complex in West Texas, just to keep servers running. Gas turbine prices are surging, Bloomberg reported Wednesday, crimping efforts to power these very facilities. The capital flowing into AI infrastructure has reached a scale where it distorts labor markets on one side and commodity markets on the other. This is the tension the Fed is watching. Rate hike expectations have climbed. Markets are now pricing in the possibility that the next move is up, not down. Goldman pushed back Wednesday, arguing in a note that the hawkish shift is overblown and maintaining its call for 2 rate cuts in 2026. But Goldman's case rests on inflation cooling and growth softening, both assumptions that get harder to defend when companies are simultaneously firing workers to free up billions for construction projects that drive equipment costs. The weight of evidence tilts toward a Fed that stays frozen longer than markets expect. If AI CapEx continues at this pace, the inflationary impulse the St. Louis Fed identified will keep the central bank pinned. But this only holds if corporate spending commitments remain firm. Oracle stock rose on the layoff news. If it falls, if shareholders punish the AI spending rather than reward the cost cuts, the CapEx cycle cools and the inflation argument weakens. The benchmark to watch: Oracle's $16 billion belated digital data center financing. If that deal closes this quarter, the AI spending wave is accelerating. If it stalls, the Fed gets its opening to cut. Either way, the 30,000 people who lost their jobs on Tuesday are not coming back.